What is up, guys? Welcome to another video. Today we're going to be jumping in how to correctly trade inverse fair value gaps, because it seems like most of you guys are probably trading them wrong just because it's like a little trend right now to kind of trade inverses, like, ooh, inverses are so good. And what I'll notice is, people taking every single inverse fair value gap. It's like, all right, boom, we got an inverse fair value gap. Let's mark this out. I'm gonna short this, right? It's like, oh, we got an inverse fair value gap, same thing. I'm gonna short this, right? And first thing I wanna go over in this video is, obviously that's not how you trade, right? That's not how you trade, but I wanna go over why that's not how you trade. Now, what is an inverse fair value gap, right? So an inverse fair value gap is when a fair value gap, like right here, we have right here, boom, it gets closed below, basically ran through, right? Boom. Now, the issue is, what you guys think is, since the market creates an inverse fair value gap, it just means that we have to go that way. We have to go direction. You guys are assuming that the market, is going to see that inverse and say, hey, now we're going to flip, right? That's obviously, if you apply a little bit of logic, guys, that's obviously not how it is, right? But why an inverse is so powerful is because of a confirmation, right? The thing about the inverse fair value gap is it's going to confirm an idea, right? Now, why is it going to confirm an idea? Well, let's apply a little bit of logic, because that's really what trading is, right? Now, imagine we are, in this case right here, we will scale down here and go to right here. Okay, so we'll go back right here. Okay, so what do we have right here, right? Price action, as you can see, relatively bullish here, kind of moving higher, right? Looks like we have some highs that we're looking to take up here. Boom. Now, scale down. Okay, so what we're doing currently is we're retracing, right? We're currently retracing, as you can see here, boom. And in this retrace, we leave a fair value gap, right? And at the same time, we are also in this 1 minute gap right here, boom. So with some logic, the only thing that's really stopping us from going any higher is going to be this bearish gap right here on the 1 minute. And kind of the thing that's stopping us from going lower is this 1 minute gap right here. And after we break that, I would assume maybe we'll go down to something like this 1 minute gap, or the 5 minute gap, which is like right here, right? Which we already did kind of tap, but back on the 1 minute, right? So this is where you apply some logic and say, hey, this would be an example of a good inverse gap. Why? Well, if this bearish gap if this bearish gap gets disrespected, it says, hey, price, this is the one shot that price had to continue lower, right? Let's play this out. Okay, get a little bit of reaction, and then bam, close above. So the reason why this is a good example of an inverse gap is it says, hey, right, this is the one chance we had at price, going lower, and we got a little respect, right? We respected a little bit, and then we broke it. This is such a good confirmation. This is a good example of an inverse because it's confirming your original idea, right? If you're originally bullish, right, you want price to go up. The only thing that's really stopping us from going up here is this inverse gap, right? This fair value gap on the 1 minute. So once this gets inversed, right, there's no reason for us to go lower, right? The only reason for us to go lower was this gap right here. And now we pretty much have a kind of a straight shot to these highs, and I marked them kind of wrong, but right here, boom. Pretty much have a straight shot to these highs, and I imagine we instantly go to take them. Boom. Exactly. So that's an example of a good inverse gap, right? Whereas, if you're seeing this right here and you're like, oh, we just got an inverse, right? We took out that high and we just got this one inverse, right here, boom, and we're just going to short that, right? That's, you're going to get gassed, right? You get stopped out here. Yeah, you get really stopped out here, right? And if you just saw, hey, liquidity sweep, inverse fair value gap, I'm a short, you would have got, you would have lost, right? And why is that? Well, if you look on the 5 minute, you're pretty much shorting into all these bullish 5-minute gaps right here, and we're obviously still kind of bullish high time frame. Even though we did take that pretty prominent high, we're still bullish, right? So that's the main issue that you guys have with trading inverses. You guys are seeing, an inverse as something that just like the whole, name old all, right? It's like, hey, inverse, boom, I'm gonna short, inverse, blah, blah, blah. You guys can't look at it this way. All it really is a confirmation of original idea, right? Let's go on some higher time frames right here to kind of imagine it as well. Okay, we'll go yesterday. We'll go to replay, select it here. We're going to go on the 5-minute right now. Okay, so the 5-minute right here, obviously very bearish, right? Very bearish right here. And, it looks like we're going to go take these lows right here. Boom. Now, once this fair value gap gets disrespected, right, this is a confirmation, right, that, hey, we might be possibly flipping, right? Price might be looking to flip here, right? It doesn't mean necessarily that we're going to. It's like, hey, inverse long, right? The reason why this is a decent confirmation that we might be flipping the narrative right here, going from, bearish to, possibly short-term bullish, is because, why? This is the singular fair value gap on the 5-minute that's kind of keeping us from going, that's supposed to take price lower. Once this breaks, right, now I can start looking at something like these highs, as they're not very protected, right? We don't have anything really protecting price from taking these highs, right? It's like this high is kind of free now, and we just have, liquidity building up. Whereas if this 5-minute were to hold, boom, that's going to be, that's going to take us lower, right? So this breaking, this is a good confirmation inverse, not something I would take an entry off of, but you can kind of scale down here and okay, boom, right here. So another example here, boom, retrace, kind of tap this 1-minute gap right here, and you get this confirmation right here. This kind of 1-minute tiny gap getting disrespected, showing us that, hey, possibly we're going to start to go higher now, right? I would imagine this might play out here. Again, not the cleanest trade. Personally, something I probably would not take, but I would imagine it might play out here. Okay, it does play out, right? Kind of same example right here with the confirmation. Boom, this 1-minute gap is kind of what's stopping us from going any, lower, right? My bad, it's what's keeping us from, going any higher. So when that breaks, it's like, hey, now we can look for higher, right? But again, it's not just because, boom, inverse, break that, right? Like boom, inverse long, right? It's not how it works, right? If you take every single inverse, you're just going to get, you're going to get a lot of losses, right? You can't look at it like that. You have to look at each inverse as just a confirmation of your original idea. So if you're already bullish, right, you want to see a bearish gap get ran through, inversed as a confirmation to take your entry. That's all I really look at it is, one, to take it as an entry when you already have your narrative, or two, it's to flip your narrative. It's like, hey, this got inverse. This is a good sign that, we might be flipping, right? So that's the main thing I look at when I look at inverse fair value gaps. And this is what I recommend you guys to do. Otherwise, you will probably take a lot of unnecessary losses. You're going to say, oh, inverses don't work, all this stuff, because you're just ending up, taking every single inverse out there. And obviously, that's not how the market moves, right? So main thing you guys kind of have to realize, boom, all an inverse is, right, is confirmation of an idea, right? It's a good sign because, fair value gaps usually are going to hold. So when that breaks, it's a good sign that, hey, we might be going, we might continue going where we're supposed to go, right? So it doesn't mean, we're going to reverse. That's not what it means. Usually I'll just look at it as a confirmation for continuation or, changing my original bias, right? Again, stop looking at it as just like some mechanical thing. It's like, hey, inverse fair value gap, long, short, right? Obviously the market does not care about your inverse fair value gap. They could care less, even though it's some like trendy thing right now, doesn't really mean anything, right? So make sure you guys are trading them correctly. Make sure you learn how to utilize them, and it'll improve your win rate. It'll improve your mentality too, because you're gonna, lose less, and you'll learn how to actually utilize them. And again, understand why you're taking them. The reason why I trade them like this is that's logic, right? If you apply any sort of logic to your trading, this makes sense. Whereas, taking, liquidity sweep inverse, this, just random inverse, enter, right? That doesn't have any logic. That's just, pattern trading. This, you're using some logic, right? You're not trading patterns. You're using some logic and some common sense to enter your trades. But that's pretty much it for today's video. I really wanted to go over this because it makes me mad when people trade these wrong, right? So this is what I would like to say is the correct way to trade them. And if you guys enjoyed the video, make sure to subscribe. If you guys want to work with me one-on-one, you can apply in the bio. I'll kind of help you out. But anyways, that's pretty much it for the video. I will catch you guys in the next one.